Imagine you're trying to steer this colossal, heavily loaded cargo ship right through the middle of a Category 5 hurricane.
Yeah, not exactly a relaxing cruise.
Right. It's a nightmare. You've got geopolitical trade wars disrupting all your supply routes. Inflation is just driving up the cost of the fuel you need to keep moving. And extreme climate events are physically battering the hull of the ship.
It's a complete macroeconomic storm, basically.
Exactly. But to make matters even more complicated, and this is the crazy part, the ship's original architect, like the person who designed the very vessel that is keeping you afloat, has just passed away.
Oh, wow. Yeah, that changes the dynamic completely.
It really does. You have to rely entirely on the systems he built to survive a storm unlike anything this ship has ever sailed through before. And that, in a nutshell, is exactly the situation global insurance titan AXA found itself navigating in 2025.
It's honestly a perfect encapsulation of operating in what economists like to call, macroeconomic muddy waters.
Muddy Waters is putting it lightly.
Right. I mean, the sheer volume of concurrent crises happening globally right now, it really tests the structural integrity of every multinational corporation out there,
Well, welcome to the deep dive. Today, we are cracking open AXA's 2025 Universal Registration Document.
which is quite the document.
Yeah, it's massive. It's this extensive, remarkably detailed annual financial and strategic report from literally one of the largest financial institutions on the planet.
But just to be clear, our mission today isn't to just read you a spreadsheet or recite a bunch of dry regulatory jargon.
No, definitely not. Nobody wants to listen to that.
Exactly.
Our goal here is to extract the mechanics of how a global titan manages global chaos. We want to look at this document as basically a blueprint for navigating a world that's defined by geopolitical fractures, accelerating climate change, and of course, the total explosion of artificial intelligence.
There's a lot of ground to cover.
There is. Okay, let's unpack this.
Yeah. So to truly grasp the gravity of this 2025 report, I think we have to start with the foundation of the company itself. Because, this is a profoundly significant year for AXA on a purely human level.
Yeah, the document actually opens with a very poignant tribute. It notes the passing of AXA's founder, Claude Bébert, in 2025.
Right. And when you read through the history of his legacy that's detailed in the report, you really start to understand just how extraordinary the company's trajectory has been under his original blueprint.
It's wild. I mean, he built this massive conglomerate essentially from scratch in less than a generation.
The scale of that corporate evolution is exceedingly rare. I mean, Bébert took a small regional mutual insurance company based in Normandy, France.
Just a little regional player.
Exactly. And he's systematically engineered it into a global powerhouse. The report highlights these structural milestones that are really crucial for context today.
Like the 1982 takeover, right?
Yeah, in 1982, he executed the takeover of Groupe Drouot, and that provided the critical mass they needed for national dominance in France.
And then just a few years later.
Right. By 1985, he created the AXA brand itself. He designed this unified banner to export that dominance globally.
And what really struck me is how the report frequently emphasizes his underlying philosophy. Like, it frames him as a humanist who firmly believed that companies have a vital structural role in maintaining societal stability.
Which is a heavy responsibility.
It is. And that philosophy gets severely tested when you look at the 2025 landscape described later in the report by the current CEO, Thomas Bruverell, and the chairman, Antoine Gossett-Grainville.
Yeah, they do not paint a rosy picture of the global economy.
Not at all. They outline a world dealing with the rapid reshaping of global alliances, trade wars disrupting international supply chains, and rising public debt that severely limits what governments can actually do to protect their citizens.
What's fascinating here is how the underlying mechanics of insurance actually respond to that exact kind of macroeconomic storm.
How do you mean?
Well, in a highly volatile environment, an insurance company doesn't just absorb the chaos. It actually acts as an economic shock absorber.
Okay, walk me through that.
Let's look at the mechanism of inflation, right?
Yeah.
When global supply chains break down, the cost of labor and materials skyrockets.
Yeah, everything gets way more expensive.
Exactly. So that means the cost for AXA to pay out a claim like, say, replacing a car's microchips or buying lumber to rebuild a burned-down house increases dramatically.
So that's a massive headwind for them.
It is a severe headwind.
Mm-hmm.
But you have to remember, the central banks don't just sit still.
Right, they hike rates.
To fight that inflation, they keep interest rates elevated compared to, the pre-pandemic era. And that is where the counterbalance kicks in.
Because insurers have all that cash sitting around.
Well, They don't just hold premium money in cash, they invest those vast reserves of capital.
Mm.
So when interest rates are high, they earn significantly higher yields on their enormous bond portfolios.
Ah, I see.
They use a strategy called asset liability matching. It basically ensures that the long-term bonds they buy generate enough yield to cover the long-term payouts they anticipate having to make down the road.
So, wait, the very macroeconomic forces creating risk on the claims side of the ledger are actually providing a stabilizing, compounding financial return on the investment side,
Exactly. It's a built-in hedge.
which perfectly sets up the question of how this ship actually held up in the storm. AXA is currently in the second year of its 2024 to 2026 strategic plan.
You unlock the future plan.
Right, unlock the future. Let's look at the financial engine driving that plan because the numbers are staggering. The revenues rose 6% to hit 116 billion euros.
That's a billion with a B.
Billion with a B, generating underlying earnings of 8.4 billion euros.
And when you look closely at how those enterprise-level earnings translate down to the shareholder level, the efficiency becomes really apparent.
Yeah, the per-share metrics are strong.
AXA's underlying earnings per share grew by 8%, which actually hit the absolute top end of their target range.
Good.
Furthermore, their underlying return on equity, which for those who might not live in financial statements every day, measures how effectively management is deploying the company's net assets to generate profit, is sitting at 16%.
Is 16% considered high for an insurer?
Very. In
Yeah.
the financial sector, maintaining a 16% return while carrying the strict capital requirements of an insurer, it requires incredibly rigorous asset management.
And speaking of capital requirements, making a profit in insurance is like only half the battle, right? You also have to mathematically prove to regulators that you can survive an apocalypse.
Literally.
The report notes their solvency TUS ratio is at 224%.
So Solvency to SEC is this remarkably strict European regulatory framework. It forces insurers to run complex predictive models to calculate the exact amount of capital they need to hold to guarantee they can meet all their obligations over the next 12 months.
Even if everything goes wrong at once.
Exactly. Even if a 1 in 200-year catastrophic event occurs.
So what does a 1 in 200-year event look like in their models?
We are talking about stress testing for scenarios where, say, a historic European windstorm happens in the exact same week as a global stock market crash.
Just a worst-case scenario.
Right. A Solvency II ratio of 100% means you have exactly enough capital to survive that black swan event.
Okay, and AXA is at 224%.
Yes, meaning they hold more than double the legally required survival capital. It is what analysts call a fortress balance sheet.
That's wild. And looking at the architecture of that 116 billion in revenue, the portfolio is built to hedge against isolated shocks, too.
Oh, absolutely.
The business is split exactly 50% from individuals and 50% from companies. And then breaking it down by specific business lines, property and casualty, or P&C, makes up 50% of revenues.
Pulling in about 5.9 billion euros in earnings on its own.
Right. Savings makes up 18%, health is 16%, and protection is 15%.
That 50-50 split between corporate and individual risk,
Yeah.
that is highly intentional.
How so?
Individual policies, like personal auto or home insurance, they're high volume, but relatively predictable on a macro scale. Corporate risks, like insuring a multinational supply chain or a massive fleet of cargo ships, are much lumpier and way more complex.
But they bring in huge premiums.
Exactly. They offer significant premium volume. So by balancing them perfectly, a sudden spike in, say, personal auto claims due to a bad winter doesn't derail the entire corporate balance sheet.
Okay, wait. With climate change causing extreme weather events left and right, and inflation driving up the cost to rebuild, how is their property and casualty sector actually making money? Shouldn't those payouts be eating their profits alive right now?
You would think so, but the answer lies in the mechanics of a metric called the combined ratio. And for AXA's P&C business, it actually improved to 90.6%.
What exactly is a combined ratio?
It is basically the lifeblood metric of a P&C insurer. It calculates incurred losses and operating expenses as a percentage of the earned premiums.
Okay, so the ratio is 100%.
If it's 100%, the insurer is just breaking even on their underwriting. They're paying out exactly what they're taking in.
So a 90.6% ratio means...
It means that before they even touch the investment yields we discussed earlier, their core underwriting engine is highly profitable. They are keeping nearly 10 cents of every dollar in premium as pure underwriting profit.
But how are they driving that number down in a year filled with natural disasters?
It really comes down to two highly technical mechanisms. dynamic pricing discipline, and reserve prudence.
Meaning they're just jacking up prices.
It's more sophisticated than that. They aren't just reacting to disasters after they happen. They are actively utilizing predictive modeling to adjust their pricing algorithms in real time, matching the new reality of climate risks.
Oh, I see.
If a coastal region's risk profile changes due to, rising sea levels or more frequent hurricanes, the premiums are systematically adjusted to reflect the statistical probability of a payout.
And the market just accepts those higher prices.
Well, the growth across their portfolio shows this worked. Premiums for small and medium enterprises grew 4%. Their large and specialty risks division, AXA grew by 3%, and personal lines grew by 7%.
So they're actually growing the business while raising the bar.
Yes, they're expanding their reach, but strictly enforcing a standard where every new policy is priced accurately against current inflation and current climate data.
Man, when an underwriting engine is running that efficiently and generating billions in surplus profit, management is forced to make some pretty strategic decisions about how to allocate that capital.
It's a good problem to have.
Definitely. Here's where it gets really interesting. In 2025, AXA executed a fundamental structural shift by selling off AXA Investment Managers, or AXA IM, to BNP Paribas.
From a corporate strategy perspective, this move is a masterclass in structural focus.
Think of it like pruning a massive oak tree.
Okay, I like this analogy.
You have this towering ancient tree, right? And the arborist decides to take a saw and cut off a very large, entirely healthy branch. You don't cut it because the branch is sick or dying. You cut it so the tree can redirect all of its water, nutrients, and energy into growing its core trunk thicker and stronger.
Right.
In this scenario, that core trunk is pure insurance and underwriting.
It's a very precise way to visualize the corporate restructuring, because operating an in-house asset management firm is fundamentally different from underwriting risk.
Totally different business.
It demands entirely different operational frameworks, separate regulatory compliance teams, and very diverse capital allocation strategies. So by selling AKIM, management essentially removes the operational drag of running a secondary financial vertical.
But don't they still need to offer investment products to their clients?
They do, and they didn't abandon the capability. They secured a long-term partnership with BNP Paribas to ensure they can still source savings products for their clients. But structurally, it isolates their capital and attention entirely on scaling their core technical excellence in insurance.
The financial engineering behind the sale is just as compelling, too. I mean, when you sell a profitable division like AXAIM, your overall enterprise earnings the following year will inevitably drop, right? Because you no longer own that revenue stream.
Right, which analysts call earnings dilution.
Exactly. So to prevent their stock price from taking a hit, AXA took the cash from the sale and launched an immense 3.8 billion euro share buyback program.
Which is just a brilliant lever to pull. By purchasing their own stock on the open market and retiring those shares, they permanently reduced the total number of shares in existence.
Making the remaining slices of the pie bigger.
Exactly. Even if the company's total net income is slightly lower without the asset management wing, that income is now divided among significantly fewer shares. This effectively insulates the earnings per share metric, protecting the remaining investors from dilution.
Combine that with a total dividend payout ratio of 75% and a dividend increasing to €2.32 per share, and you are looking at a management team hyper-focused on capital velocity.
Moving money out of non-core assets and returning it directly to the owners.
And they are also strategically deploying that capital into targeted acquisitions, specifically buying Nobis and taking a majority stake in Prima. Both of these operate in the Italian market.
Prima is the acquisition to watch closely there.
Why Prima?
They are a leader in the direct insurance market in Italy. And direct insurance is a distribution mechanism that entirely bypasses traditional brokers and physical agents.
So it's all online.
Yeah, it interacts with the customer through digital-first platforms. So acquiring Prima doesn't just increase AXA's market share in European P&C, it actually injects advanced technological distribution capabilities directly into their corporate bloodstream.
That makes total sense. Now, we've spent a significant amount of time breaking down, billions in revenue, combined ratios, and share buybacks. But let's pause and translate that corporate finance into actual societal function.
Good idea.
It is very easy to look at your monthly home or auto insurance premium as just another annoying bill. But when you look at the raw data in this report, you are forced to reevaluate the entire industry as really the fundamental engine of the global economy.
I'd argue that without a functioning insurance market, modern capitalism effectively halts.
Really? halts completely.
Think about it. A bank will not issue a mortgage without a guarantee that the physical asset is protected against fire. A shipping company cannot load a vessel with millions in electronics if a single storm could bankrupt the entire enterprise.
That's right. The risk is too high.
Insurance is the mechanism that unlocks the flow of credit in commerce.
And you really see that when you look at the sheer scale of the capital outflows here. AXA employs 156,000 people globally. But beyond payroll, in 2025 alone, they paid out over 49 billion euros to their customers.
That is a staggering number.
Right. That is 49 billion injected directly into local economies to rebuild neighborhoods after wildfires, replace commercial fleets, and fund critical medical treatments.
And that's just the claims payouts.
Exactly. Because of the investment mechanisms we discussed earlier, they also deployed 40 billion euros directly into the economy, funding municipal infrastructure, corporate debt, and government bonds. Oh, and they paid 12.8 billion in global taxes.
If we connect this to the bigger picture, you start to see how an insurer views global vulnerability through the lens of what they call protection gaps.
Protection gaps.
Yeah, protection gap is essentially the delta between the total economic losses caused by a disaster and the amount that was actually covered by insurance.
So the uninsured losses.
Right. And as extreme weather events escalate, the property protection gap is widening dramatically, simultaneously over in the life and health sectors. As global demographics skew older and the cost of medical technology rises, the health protection gap is expanding too.
But the report makes it very clear that closing those gaps isn't viewed as just some, philanthropic obligation. It is actually identified as a primary structural growth opportunity for the company.
Precisely. As public debt limits the ability of governments to provide sweeping safety nets, private insurers step into the void. Like in 2025, AXA deployed 438 million euros specifically to handle the fallout of climate disasters just in France.
Wow.
But they are also innovating at the microeconomic level. The report details their ambition to protect over 20 million customers with inclusive insurance propositions by the end of 2026.
What does inclusive insurance look like in practice?
These are specifically engineered, highly affordable policies designed to provide baseline security for modest-income households and small enterprises, the exact demographics that typically fall into those protection gaps.
A prime example of this that they mention is their partnership with Correos.
Right, the national postal network in Spain.
Yeah. They're using the post office to distribute these inclusive policies. They are basically utilizing existing infrastructure to reach people who would never, ever walk into a traditional insurance brokerage.
It's a very smart distribution.
It is. And they tie the societal impact directly back to their founder's legacy. In 2025, they established the AXA Foundation for Human Progress, which consolidates all their global philanthropic efforts in memory of Claude Bébert.
It creates a really cohesive corporate narrative. But, while the company is honoring its 20th century roots, the final year of the Unlock the Future plan in 2026 is entirely focused on a capability Bébert could never have anticipated.
Which is?
The massive deployment of Gen AI.
Oh, absolutely. The report heavily emphasizes the shift toward predictive artificial intelligence and generative AI. And honestly, this pivot makes complete sense when you realize that the insurance industry is essentially sitting on a vast, untapped reservoir of unstructured data.
Insurance has always relied on data, right? But for decades, it was limited to structured data.
Stuff that fits on a form.
Exactly. Information that fits neatly into a spreadsheet. Driver age, vehicle make, zip code, roof age. But unstructured data accounts for the vast majority of real-world information.
Like what?
It includes things like the audio recordings of a frantic phone call after a car crash, or the drone photographs of a hurricane-damaged roof, or the messy handwritten notes from a physician on a medical chart.
Right. And historically, converting that chaos into a mathematical risk profile required thousands and thousands of human hours.
It was incredibly labor-intensive.
But the report details how AXA is now deploying Gen AI to ingest and process that exact type of unstructured data. So instead of an adjuster driving 3 hours out of town to inspect a damaged warehouse, a drone captures the imagery. The AI uses computer vision to assess the pixel damage against a database of millions of previous claims, and it generates a pricing estimate instantly.
It's revolutionary for claims processing.
It really is. They are utilizing natural language processing to extract relevant health data from complex medical bills to accelerate those claims. And they're deploying Gemini chatbots to construct highly personalized coverage models based on very specific customer behaviors.
Which all sounds incredibly efficient.
It does. But I am looking at this technological shift and trying to reconcile it with their core philosophy.
How do you mean?
If their whole purpose is acting for human progress by protecting what matters, doesn't handing over underwriting and pricing to an AI algorithm strip away the human element entirely? Like, doesn't the business just become a cold, calculating algorithm optimizing for profit?
That is the central tension of the modern financial era. But the operational reality detailed in their strategy actually suggests the exact opposite outcome.
Really?
Yeah. By utilizing AI to handle the immense administrative burden of unstructured data, automating the extraction of billing codes, or running the complex mathematical probability of a localized flood, you actually liberate your human capital.
Okay, I think I see where you're going with this.
When your employees are no longer chained to manual data entry, they can deploy complex human empathy where it is actually required.
So the adjuster is freed up to actually speak with the family who just lost their business rather than spending 4 hours typing up the incident report in a cubicle.
Exactly. The machine handles the processing so the human can handle the relationship. And this is particularly transformative in the health sector.
Oh, I bet.
Predictive AI allows AXA to shift from a reactive model to a proactive one. So instead of simply processing a hospital invoice after a customer suffers a cardiac event, the AI can analyze disparate health data points to identify early warning signs.
So they catch it before it happens.
Right. This allows human healthcare professionals to intervene early with preventative care models, keeping the aging population healthier for longer. The technology enables the humanism.
That is a fundamental rewiring of how the industry operates. It's fascinating. So let's pull all of these threads together. We began this deep dive by looking at the foundations laid by Claude Bébéar, this small mutual insurer in Normandy built on the philosophy of societal protection.
Right.
And we've watched that blueprint evolve into a 116 billion euro, highly digitized global entity.
An entity that, amidst the intense macroeconomic headwinds of trade wars, inflation, and climate volatility, still engineered an 8% growth in earnings per share.
Huge performance.
They demonstrated immense capital discipline by pruning their asset management division to reinvest in direct insurance distribution. They orchestrated massive share buybacks, all while injecting tens of billions of euros back into the global economy to close societal protection gaps.
And as they accelerate into 2026, leveraging Gen AI and predictive modeling, it leaves you with a really fascinating conceptual paradox.
Let's hear it.
Well, for centuries, the fundamental premise of the insurance industry was built entirely on the pooling of unpredictable risks.
Right.
We all contribute to the pool because no single person knows if their house will flood or their car will crash tomorrow.
But as AXA and the broader industry deploy machine learning to achieve near-perfect underwriting accuracy, analyzing billions of unstructured data points to predict outcomes with granular precision, what happens to the core philosophy of insurance when the unpredictable becomes almost entirely predictable?
Exactly.
If an algorithm can forecast a localized risk with absolute certainty, the very concept of shared communal risk transforms completely.
It evolves from risk protection into pure risk management. So what does this all mean? It means the future is already here and it's heavily insured.